Step onto any retail trading forum, scroll through finfluencer feeds on X or YouTube, or look at how standard financial media packages the narrative, and you will find Nokia treated as a relic of a bygone era. To the untrained retail eye, the kind of investor chasing high-beta meme momentum or blindly buying mega-cap AI chip darlings, Nokia Corporation, trading comfortably in the mid-$9 to $11 range with a market capitalization that reflects old-world baggage, is casually written off as a slow-moving legacy European telecom equipment maker. Mainstream consensus views it through the dusty lens of cyclical carrier spending, sluggish 5G rollouts, and the painful memory of a phone empire lost to smartphone disruption. But this widespread perception is not just outdated, it is one of the most glaring market mispricings in modern technology infrastructure. While retail investors scroll past the ticker, institutional smart money and major Wall Street desks have methodically re-architected their thesis around a hidden physical reality that defines the modern artificial intelligence boom: the data bottleneck. The financial media loves to obsess over silicon compute power, counting transistors, debating GPU architectures, and tracking cluster sizes across hyperscale data centers. Yet every single advanced AI cluster, from OpenAI to Microsoft and Meta, is running headfirst into a severe physics wall known as the interconnect and optical transport bottleneck. You can stack tens of thousands of high-end accelerated computing chips side by side, but if you cannot move exabytes of data between distributed server racks, clusters, and regional cloud nodes at the speed of light with absolute determinism, your multi-billion-dollar compute farm becomes an expensive, idle parking lot. Photons must replace electrons for long-haul and intra-data center scale, and this is where the market completely misses the plot on Nokia. Far from being a passive seller of cellular radio towers, Nokia has quietly transformed into an indispensable optical networking and IP routing heavyweight. The company's recent earnings performance reveals an explosive operational pivot. Multi-billion-dollar order intake from cloud and AI customers is surging, with optical and IP network growth rates forcing management to aggressively revise guidance upward. The market is pricing Nokia like a stagnant utility, while its core growth engine is firing on cylinders driven directly by the hyperscale AI data infrastructure build-out. Market dynamics and institutional positioning. The daily trading tape for Nokia tells a fascinating story of structural accumulation masking beneath quiet consolidation ranges. As institutional heavyweights position themselves for the multi-year transformation of global data infrastructure, retail traders frequently get shaken out by short-term headline noise regarding sluggish traditional telecom carrier capex. When macroeconomic jitters cause broad market pullbacks, or when sequential quarterly reports show temporary lumpiness in legacy mobile segments, algorithmic short sellers and impatient retail investors dump shares, creating textbook institutional accumulation zones. Big money desks aren't buying Nokia for a quick weekly swing trade. They're establishing massive multi-year positions based on an undeniable order backlog. Consider the mechanics playing out behind the scenes. Nokia's recent financial reports highlight billions in cloud and AI-driven order intake, with optical network subsegments printing sequential growth rates that dramatically outpace legacy segments. Major brokerage houses like Bank of America and Jefferies have consistently revised their price targets significantly higher, emphasizing that hyperscaler engagement across Nokia's optical portfolio and data center switching units is accelerating far faster than consensus models originally projected. While retail participants obsess over daily fractional price swings on platforms like Robinhood or Webull, institutional funds are tracking the long-term conversion of order backlogs into high-margin revenue streams. Gross margins are structurally expanding well past historical baselines, driven by an advantageous product mix shift towards software-defined networking, artificial intelligence-optimized radio access networks, or AI-RAN, and high-end optical routing. Before we dive deeper into the operational shifts powering this transformation, let's pause and look at the market participation. Are you currently holding Nokia shares in your long-term growth portfolio, or are you sitting on the sidelines waiting for a deeper macro pullback to initiate a position? Drop your thoughts and share counts in the comments below, and let's examine how the underlying business model supports this thesis. Business model and historical context. To understand why Nokia's current market valuation fails to capture its true intrinsic power, one must completely discard the obsolete mental model of the company as a mobile phone manufacturer or a basic cellular hardware vendor. Nokia has executed a profound corporate metamorphosis. Effective through its strategic reorganization, the company streamlined its operations into two primary operating engines: network infrastructure and mobile infrastructure, alongside dedicated portfolio and technology standards units. The crown jewel of the modern investment thesis and the primary driver of multiple expansion lies squarely within the network infrastructure segment, which encompasses optical networks, IP networks, and fixed networks. For years, Wall Street lumped these high-margin, mission-critical infrastructure assets with sluggish mobile radio hardware, dragging down the company's valuation multiple. But when you disaggregate the business, a striking reality emerges. The optical transport and IP routing units are deeply embedded in the backbone of the global internet and hyperscale cloud networks. Nokia's proprietary digital signal processors, spanning families like Ontario, Huron, Superior, and Pacific, are engineered to optimize data transmission across distances ranging from short intra-data center links to 15,000-kilometer transoceanic submarine cables. Contrast this modern engineering triumph with the historical framing of the company. In the past, Nokia's fortunes were tied to the volatile consumer handset cycle and lump sum carrier upgrade spending for 3G and 4G networks. Today, the demand vector has entirely shifted. The primary buyers of Nokia's most advanced optical gear are not just traditional telecom operators like AT&T or Vodafone, but massive cloud service providers and hyperscalers building out data center interconnects to feed the insatiable computational appetite of large language models. Furthermore, the company's legendary patent portfolio, housing decades of fundamental cellular and connectivity innovations, operates as a high-margin cash cow integrated into its technology standards framework. This creates a powerful financial dual engine, a stable, high-margin intellectual property baseline, combined with high-growth secular exposure to AI data center infrastructure. Future outlook, catalysts, and risks. Looking out over the multi-year horizon, Nokia is positioned at the intersection of several massive structural tailwinds that could fundamentally re-rate the stock. The most immediate technological catalyst is the rapid commercialization of its AI-RAN architecture, developed in close collaboration with accelerated computing leaders like NVIDIA. By integrating artificial intelligence directly into the radio access network, Nokia enables mobile operators to dynamically manage network capacity, slash energy consumption, and create a seamless software upgrade path towards future 6G standards. Crucially, this shifts Nokia's business model away from bare metal hardware sales towards high-margin recurring software subscription models. On the geopolitical and supply chain front, macroeconomic shifts are turning into structural tailwinds. Increased regulatory scrutiny and potential legislative restrictions on foreign networking gear, such as U.S. and allied policy moves targeting non-allied optical transceivers, are forcing telecommunications providers and enterprise network architects to pivot aggressively towards trusted, Western-aligned vendors.
Nokia, alongside key Nordic peers, stands as an indispensable Western geopolitical anchor for critical national security and telecommunications infrastructure. However, prudent investors must always weigh these monumental catalysts against legitimate operational risks. Nokia's growth trajectory remains inextricably linked to the capital expenditure cycles of mega-cap tech spenders and telecom carriers. If hyperscalers experience a sudden digestion phase or moderate their data center capital expenditure budgets due to macroeconomic tightening or ROI friction on artificial intelligence monetization, order intake velocity could temporarily soften. Additionally, executing a complex corporate restructuring while scaling next-generation optical platforms requires flawless operational discipline. Execution missteps or supply chain constraints on advanced components could compress operating margins. Yet, when you step back from the quarterly earnings noise and analyze the structural horizon, the overarching narrative is clear. Nokia has successfully transitioned from a misunderstood legacy recovery play into a critical hardware